All right, welcome back, everyone. This is week 5 of building a portfolio. This week, I'm going to go over a couple of investments that I hope represent pretty easily the idea of supply and demand. But before I go further, just got to let you know that I'm not a financial advisor, so make sure you do your own due diligence. And without further ado, let's get started. All right, so over the foreseeable future, I'm going to be investing pretty heavily in the renewable energies market, as well as the electrical vehicle industry. It's just the past few days, I've just been seeing signs that this market is primed for growth, as well as has such a high demand relative to supply. For the course of the video, I'm going to highlight different shareholders, in particular the businesses, the consumers, as well as the government, and their invested interest in developing this technology, implementing infrastructure, and providing incentives for everyone else to kind of get on board. So, sign number one is the overwhelming global response to the transition to renewable energy. Although most people would agree that we have a long ways to go in terms of addressing greenhouse emissions, I just wanted to give you a list of some of the accomplishments as well as the long-term goals by the major powers of the world. Okay, so first is Germany. Germany actually just started producing 50% of its electricity from renewable energy resources, and they expect to reach 100% within the next 20 years. You also have China. China is the world leader in the renewable energies sector by far, and that's largely because they're the biggest contributors to greenhouse emissions. But nonetheless, this has allowed them to pour in so much money to research and development, where harnessing renewable energy has become just as cost effective as using fossil fuels. And then we also have the US. Joe Biden just released a statement saying that he's dedicating more than $2 trillion to the renewable energies industry, in particular setting up infrastructure as well as providing incentive to develop technology. All right, so here represents a schematic for the global activity regarding renewable energy. As you can see, there's just been an increase in capacity to harness and use renewable energies to create electricity. And this rate for renewable energy has been growing a lot faster than newly installed infrastructure for nuclear power as well as fossil fuels. The second sign actually comes from the response from the different car manufacturers. Here in front of us are the top 10 biggest car companies. There's just a general transition by the electric car companies to produce EVs. Here are some of the major car manufacturers and their goals. So for example, GM plans to accelerate their EV development by producing 30 EV models with the intentions of taking the highest market share in North America by 2025. You then have Toyota. They said due to the demand, they're planning to push up the rollout of their EV models by 5 years. Then you also have Ford, which is committing a whopping $29 billion. And then finally, I believe Volkswagen had the top spot. They have huge plans of rolling out their EV models within North America. Sign number 3 of the high demand is the shortage in some of the main components necessary to build these EV cars or electric cars, which are batteries as well as semiconductors. So the semiconductors are essentially chips that allow the manufacturers to integrate their software into building the cars and providing the cars with all those fancy features that you see. All right, so I hope I made a solid case for the level of demand and the potential for growth in this market. Now I'm going to go over a few investments that capitalize on the different aspects of this market. ChargePoint Holdings, ticker symbol CHPT. The current price is $33.14. You have a 52-week high is $49.48 and a 52-week low, which is $9.85. So there's a pretty substantial spread. Currently, it's in the middle. So if it does go up to that 52-week high, there's a lot of room for growth and significant returns. Now, if you shift to the right, there's just a brief description, so I'll read it quickly. It says, ChargePoint is an American electric vehicle infrastructure company based in California. ChargePoint operates the largest online network of independently owned EV charging stations operating in 14 countries and makes the technology used in it. Now I just wanted to go to this site, which is basically an article. It has a description of the top 10 companies in the industry of installing and implementing charging stations. This is a description that kind of points out how ChargePoint separates itself from the competition. So I'll read it again. It says, with more than 66,000 public and semi-public commercial charging spots and thousands of customers, ChargePoint is the only charging technology company on the market that designs, develops, and manufactures hardware and software solutions across every use case. And here, just pay attention to this one. It says, leading EV hardware makers and other partners rely on the ChargePoint network to make charging stations details available in mobile apps, online, and in navigation systems for popular EVs. So it seems like a lot of its other competitors and companies rely on ChargePoint services to make their services more user-friendly. And finally, if you head over to Simply Wall Street, just look at the comparisons of this company to industry standards as well as the market standards. Analysts say this company is a lot better in terms of future growth prospects, and they forecast a 49.1% annual earnings growth over the next 3 years. The second investment is going to be made in Taiwan Semiconductor Manufacturing Company. They're within kind of the pure play in which they don't produce their own chips that have their own brand on it, but instead other companies will outsource to them to make their chips. So for example, Apple, they have a sizable contract with Apple and they'll produce the bulk of Apple's chips. One of the noteworthy things about this company is its size. Currently, it takes up approximately 51% of the chip foundry market share, which overall the industry produced a revenue of $85.13 billion. And what's more interesting is that this company has plans to invest $100 billion. So although it already represents 51%, although the company already rakes in $1 billion of revenue, and although it's so big, it feels the need to even get a lot bigger. And that's indicative of the growing demand for these semiconductors. All right, so according to various analysts, they see a relatively low risk, and that's likely due to, again, the almost certain growing demand for their products. Secondly, they forecast a growth of 13.11% per year, and another noteworthy thing is that the earnings have grown 10% per year over the past 5 years. One of the downsides is its relative value. Currently, analysts think that the current price is a little bit overvalued, but as you can see, it's not by much, just by 2.1%. So they say it is about right. Okay, so the final investment is going to be an ETF that tracks the autonomous and electric vehicles market. The ticket symbol is DRIV. And for those who are unfamiliar with what an ETF is, ETFs are extremely advantageous because it allows you broad exposure to a given market without having to buy individual shares of different companies within that market. So if you buy an ETF, you don't necessarily have to do your research and handpick
certain companies that you think that will do well. Instead, if you have an idea that a specific industry is going to do well, then you can essentially make it easy on yourself by buying an ETF that tracks that industry. So if the industry does well, so does the ETF. All right, so one thing I look at is the expense ratio. This is essentially the fee you pay the company to manage the fund. Here it's 0.68%. So just to put that in perspective, if you were to invest, say, $10,000, you'd be paying $68 annually. Another thing I look at, sorry, I don't know if I mentioned this, but the price is $27.23 per share. All right, so just the performance alone since the inception, on average, it's been around 92-96% return. But if you look at the last year, though, it's been up more than 100%. And then finally, you have the holdings. So like I said, you can buy one ETF, and that allows you to invest in a multitude of different companies. Here are all the different companies that you are investing in just by buying this one ETF. To be expected, Toyota, Tesla, GM, Ford, but you also have other companies that aren't necessarily car companies, but help support the industry. So you have Intel. Intel produces those semiconductors we spoke about, and you have a multitude of other companies as well. All right, so that concludes the set of investments I'm making now and for the foreseeable future. I definitely want to invest heavily in this market just because it's so prime for growth. There's just so much demand, and it seems like kind of like a no-brainer.
All right, so that ends the video. Sorry if it took a little bit longer than expected. However, just to give a brief summary, the idea was to capitalize on a market that's showing high signs of growth as well as demand. The first company was ChargePoint, which is more in the renewable energy sector and focuses on setting up infrastructure for electric vehicles, such as the charging points. Secondly was the semiconductors, which are chips that companies are in desperate need of. The company was Taiwan Semiconductors. And finally was an ETF that tracks just the overall EV market. And this was an ETF called DRIV or DRIV, DRIV. If you have any questions or opinions, just leave a comment below. And if you liked the video, like and subscribe. All right, peace out, and I'll see you guys next week.